In this video, we're going to look at Husky Energy, and this is a Canadian integrated energy company. And in my videos, I run a discounted cash flow model so I can figure out the intrinsic value of the stock and compare it to the actual stock price to see if it's a buy or a sell. We also look at the financial ratios and compare them to its competitors. So let's get started with the model. This company has a market cap of $4.48 billion. And they're trading at $4.47. And next we're going to need the free cash flows. And free cash flow is how you value a company. You estimate the future free cash flows, and then you discount that number back to today's value. And that's what I'm doing in the video here right now. Now I'm going to get the net income, and this is the profit and loss according to the income statement. And I'm going to put that into the model. And we also need the revenue, which is the sales for the company. That's also on the income statement. So now that we have all those inputs in, let's get their capital structure so we know what to discount the future cash flows by. So their interest expense is $239 million. That's the interest they pay on their debt. That's on the income statement. And let's see how much debt they have. We'll go to the balance sheet. We'll go to liability section. And current debt of $950 million. That's debt due within 12 months. And long-term debt of $4.6 billion. That's debt due after 12 months. And since interest payments are tax deductible, let's get their effective tax rate. We'll go back to the income statement. We can't use 2019 because it looks like they took a loss that year. Let's use a 2018 number. So they had $1.9 billion of income before tax, and then $471 million of taxes. So the cost of debt is 3.27%. And let's get their cost of equity. We need the beta for that. That's the volatility of the stock. And the higher the beta, the more volatile the stock is. And it's 2.14, which is pretty high beta. That should give the stock a high weighted average cost of capital. Let's go back to the balance sheet, get some more information. Let's get their current assets. And these are assets that can be liquidated into cash within 12 months. And it mainly includes cash, accounts receivables, and inventory. Let's get their current liabilities. These are debts and payables that are due within 12 months. And that's $4.6 billion. And we'll get their total equity. That's assets minus liabilities. That's $17 billion. And we also need their EBIT. That's earnings before interest and taxes, or operating income. So in 2019, it looks like they had a negative operating income of $2.1 billion. So now let's look at their weighted average cost of capital. That's a blend of the cost of debt and cost of equity. And the cost of debt is 3.27%. And the weight of debt is 24%. So they don't have too much debt in their capital structure. Their cost of equity is 18.76%, and we use the capital asset pricing model to figure that out. And the weight of equity is 76%. So the weighted average cost of capital is 15%, and that's what we're going to use to discount the future cash flows. So we estimated 4 years of future free cash flows. Then we did a terminal value, which is all years past year 4. We discounted those numbers back to today's value, and we get a value for the entire company of $39 billion. We divide that by 1 billion shares, and we get an intrinsic stock price of $39. It's trading at $4.47, so it's trading at an 89% discount, so it's a buy according to the model. Let's see what Simply Wall Street values the company at. They're even higher. They're at 46 Canadian dollars. So apparently this is a good value of the stock. It's definitely a buy according to both models. Let's look at the historical stock price. So the price was trading in the 20s a year or two ago, and even closer to 25 a few years back, but it's dropped a lot recently, especially during coronavirus. It's sitting below $5. Supply and demand of the market has dictated the stock is worth under $5 now and not $10 or $15. So the market rules, and that's what they're saying. Let's look at their financial ratios to get more information. They have a negative PE because they have negative earnings. So we can't look at PE. They have a really low price of sales. That's a really good number, 0.2. Also a really low price to book of 0.3. That's price to stock over book value per share. They're doing fine in current ratio. They can cover their current liabilities. Negative ROE because they have negative earnings. Also negative interest coverage. So we can't look at those numbers. 24% debt, which is pretty good. So the best way to look at ratios is to compare them to the competitors. So I did videos on Suncor and Exxon on this channel. They're both American companies, but we can still compare their ratios to Husky Energy. So if Husky's in red, that means they're worse than the average, and if they're in green, they're better than the average. Suncor has the best PE at 9.0. Exxon has a pretty good PE at 13.2. But Husky wins in price to sales, price to book, and current ratio of the three companies. They're the only company that has a current ratio above 1. So the other companies can't even cover their current liabilities. ROE, Exxon has the best ROE, but they're all pretty weak in ROE. Debt, they're all good in debt. Exxon has the least debt. And of course, Exxon is the biggest of the three. So let me know what you think in the video. Leave a comment. Thanks for watching.